Hello, my name is Jingonelli, and today we are going to be looking at the prior period errors in accounting 3. But before I begin off, make sure you subscribe to the channel. It will bring you some good luck in your forthcoming exams. So starting off with the prior period errors, uh, potential errors may be discovered before the financial statements are finalized. So in which case they can be corrected before the statements are authorized for issue. So, however, it is possible that the error may not be detected until the subsequent accounting period. Such an error is referred to as a prior period error. So this is what they mean by a prior period error. So moving on, such errors could be caused by mathematical mistakes, mistakes in applying accounting policies, oversights, misinterpreting of facts, or by fraud. So since the standards keep on changing, we are in 2022. So as of 2022, IAS 8 requires that material prior period errors must be corrected retrospectively. So the approach is similar to that adopted for a change in an accounting policy. So what do they mean by materiality in this statement? So they mean that if something is material, uh, first of all, materiality is a component of relevancy. Materiality is a component of relevancy. Then information is material if its omission or misstatement could influence the economic decisions of the users, and by the users they mean for example potential investors, shareholders. So a potential investor can get to change his or her decision because of an error. It can make that person change his or her mind. That's why they call it a material error. So if at all you're having that element whereby the information provided due to its omission or misstatement could influence the economic decision of that user. So looking at an example here, they're saying while it's preparing the financial statement for the year 31st December 2019, the company discovers that because of an arithmetic error, its inventory at 31st December 2018 was overstated by 50,000. This is a material error, and I've already looked at what material means. So materiality, if at all the omission or misstatement could influence the economic decision of a user, like it can make the investor to change his or her mind about whether to invest in a company or not. That is what I'm trying to mean here by it. This is a material amount. So an extract from the company's draft statement of comprehensive income for the year to 31st December 2019, that is before correcting the error, shows the following. So you're having this amount in pounds, and they're having sales, you're having cost of sales sold, and then gross profit, other expenses, then profit before tax, taxation, and then profit after tax. So continuing the question, retained earnings were originally reported to be 382,000 at the 31st December 2018. So no dividends were paid in any year. It may be assumed that the company's taxation expense is always equal to 20% of its profit before tax. So the question comes here, part A, whereby they're saying prepare an extract from the company statement of comprehensive income for the year to 31st December 2019 showing restated comparative figures for the year 2018. So prepare also an extract from the company statement of changes in equity for the year to 31st December showing changes to retained earnings 2018. So here I'm to reduce this. I'm having a solution here whereby I get to have my closing stock, my opening stock. So here I'm trying to demonstrate something. This is not the solution, and you don't need to write this, but it's a way to enable you understand. So if at all closing stock increases, the cost of sales will decrease, gross profit will increase, net profit will increase, and even the tax liability will increase. So what happens when opening stock increases? Cost of sales will increase, gross profit will decrease, net profit will decrease, and tax liability will decrease. So from the income statement, or the statement of comprehensive income, when you're having your sales, less cost of sales, opening stock, add purchases, and then less closing stock. So I want to prove that once your closing stock increases, your cost of sales decreases, and I want to prove that once your opening stock increases, your cost of sales increases. So here I'm trying to prove the first one, assuming that our cost of sales is equal to 50 and all other elements, whereby I'm having cost of sales is equal to opening stock plus purchases minus closing stock, where I'm having 50 of the opening stock, 50 of purchases minus 50 of the closing stock, so it will equal to closing cost of sales as 50. So I'm assuming that this is my start point, and there has been an increase in the closing stock. So it has increased by 10. So I want to show you that once the closing stock increases, your cost of sales will decrease. So let's prove that. So let's assume this is the closing stock. I'm going to increase it by 10. So 50 plus 50, 100. 100 minus 60, you're going to get 40. So you can see that the cost of sales decreased from 50 to 40. So that is, I've proved that. Still the same applies to 50 throughout. Then if there's any increase in the opening stock by 10, what is going to happen? I'm going to increase this opening stock. Remember, it was 50, now it is 60 plus 50 minus 50. So this will 60 plus 50 to give me 110 minus 50, giving me 60. So proving that once your opening stock increases, cost of sales will increase, that is from 50 to 60. So having known that, from the question, you know that 31st December 2018, there was an overstated figure of 50, meaning that the gross profit. So if the figure here, if you are to go back, if the closing stock in 2018 increased, that means the gross profit is going to also increase. That means they overstated their figure. And if at all they have overstated their figure, it will mean you're going to clear the error, or you go back. That is, if at all they have asked you for 2019, you go back to 2018 and you clear the error as if it has never occurred. So you're going to reverse it. So you want to clear off, so you will know that you would want to clear off the overstated figure of the gross profit. So here, having known that the gross profit was increased or overstated by 50, you can decide to put that to a pause. Then let's first continue. Thus, they are saying in 2019, the opening stock was overstated by 50. So meaning that if at all in 2018 the closing stock was increased by 50, meaning it will be the opening stock for 2019. Meaning if at all opening stock increases, the gross profit will be understated. So let's look at it here. So meaning that if at all having an increase in the opening stock, that means the gross profit will decrease. That means we are having wrong figures. We are having wrong figures in the question, meaning in 2018 we are having an overstated figure, and in 2019, let me take you back to the extract. In 2019, it's an overstated figure, and this is an understated figure. So I want to go back and clear this error as if it had never occurred. That is because we are in 2019, so we are going to go back. So I had stated it here. We go back in 2018 to clear the error as if it had never occurred, because we want to extract something. We want to extract the comprehensive income, or the statement of comprehensive income for 2019. So that means you have to go back to 2018 and clear the error as if it has never occurred. So what am I going to do in 2018? If I was to reduce my gross profit, remember it was overstated. If I was to reduce my gross profit, which was overstated by 50,000, I must increase my cost of sales by 50 to reduce the overstated gross profit. This is what I mean here when I'm to go back. So remember, my closing stock in 2018 was increased, and I want to reduce my gross profit. So if at all, I'm to take you back here, my gross profit is being overstated. If I want to reduce my overstated gross profit, I must increase the cost of sales to reduce the overstated gross profit. So let's see if at all I reduce my cost. So from here, if at all my closing stock increases and then I get to reduce my cost of sales, sorry, let me take you back. I must increase. In 2018, if I was to reduce my gross profit, which was overstated by 50,000, I must increase my cost of sales by 50 to reduce the overstated gross profit. So it will mean, if I'm to go back, if at all I want to reduce the gross profit, so when I look at these two, when do I have a reduced gross profit? I always have a reduced gross profit if at all there's an increase in the cost of sales, meaning that I have to increase, or you can just think of it and you be like, if at all the profit is high and I increase my cost of sales, meaning that the profit will automatically go down because the costs are high. Once the costs are high, your profits are going to reduce. So that is just like general knowledge without overthinking. So once the costs are high, my profits are going to reduce. So in 2018, if I want to reduce my gross profit, which was overstated, I must reduce the gross profit by that exact figure of 50. So once I reduce my I must increase my cost of sales by 50. So meaning that if my cost of sales increase by 50, it will automatically reduce the overstated gross profit. So meaning I'll increase, and then this will be the restated figure of the cost of sales, which is 540 plus 50, which is giving me 590. So in 2019, if I was to increase my gross profit, which was understated by 50, I must. So if I want now to increase an understated figure through the general knowledge, you're going to just if at all the costs reduce, your profits will increase. That means I must reduce my cost of sales by 50% to increase the understated gross profit. So the restated figure is going to be cost of sales is equal to 750 minus 50, which is going to give me 700. So if at all I want to increase my cost of sales, I'm going to if I want to increase my gross profit, I'm going to just reduce the costs. Once the costs reduce, take you back. Once the costs reduce, it's going to increase my gross profit. So having looked at that, now if at all I'm to draw an extract of the comprehensive of the statement of comprehensive income, it will be the sales, they won't change, 940, and side 790. Now the cost of sales will change, will bring the restated figure of 590 and 700, 2018, 2019, and then the gross profit will be this minus this, you're going to get 200, and this minus this, you're going to get 240. So other expenses which are going to reduce, these ones remain the same. They were 110, 120. So 200 minus the 110, you're going to get 90, and 240 minus 120, you're going to get 120. So this is the profit before tax And from the question, if at all we had to go back and reread it, they had said it may be assumed that the company's taxation expenses or is equal to 20% of its profit before tax. So this will be it. So 20% of profit before tax. 20% of 90 is going to give me 80. 20% of 120 is going to give me 24. So profit after tax is going to be 72 and 96. So you can see that if at all previously we are having this 112 and 56, so you can see that this was a material. This is where the definition of material comes in, that the information is material if its omission or misstatement could influence the economic decisions of the user. So there was a misstatement of the figures there, so meaning they could influence the investor not to invest into this company, because at first it was showing that they were making a loss, and now it shows that there is at least a profit in 2019. So the extract of the part B from the question, it was asking us for the changes in equity. An extract from the company statement of changes in equity for the year to 30 December 2019, showing changes to retained earnings. Remember, the amount in the financial, or the profit in the financial, in the comprehensive income, the profit finds its way into the retained earnings. So from the question, there was a reported figure which was of it's right here. Retained earnings were originally reported to be 380,000, that is 31st December 2018, and no dividends were paid in any year. So meaning that is going to be my opening balance. So when I come here, reported retained earnings at 31st December 2012, that is of 31st December 2018, it's going to be 382,000. And then I say correction of the prior period error, which is going to be, remember the figure kept from the 112,000 to 700 to 72,000. So this is, I'm going to subtract this figure. So the difference here, it's going to give me this, which I'm going to subtract from this, so that I get the restated balances. I'm going to minus, because the figures there were previously they were being overstated, so I need to reduce. If I told they were overstated, I have to reduce this amount from the reported retained earnings, so that I can remove that figure which was being overstated, and then I get my new restated balances, which is 342,000, and then the profit for there the 31st December 2019 is going to be 96,000, and then the balance carried down, which is going to be 438,000. So I'm going to just get this restated balance, then I add onto the profit for the year at the 31st 2019. So the amount here, this amount is taken to the statement of financial position under equity. So this is the amount which you are going to take under the financial position under equity. So thank you so much for watching. Make sure you subscribe to the channel.